Let's concentrate on issues that are going to confront the economy very soon, the credit policy in particular. Chetan Ahya, Chief Asia Economist and Managing Director at Morgan Stanley, joins us on the phone line, and also with us is Shubhada Rao, Chief Economist at Yes Bank. Shubhada, Chetan, welcome to the show. Well, Chetan, I want to get your idea of how you're drawing the inflation trajectory from here on. What is the in-house Morgan Stanley view of the trajectory of crude prices over the next 1 year? And separately, what is your trajectory of inflation over the next 12 months?
So, Lata, I think for crude, I think it's a bit more of an evolving situation. The expectation was from our team that the OPEC will actually meet and decide to take some production cut. But since the way the outcome has come out, it looks like it's more favorable for the oil prices. And so in that sense, oil prices are surprising us on the downside, which is good news for India, of course, but from the oil commodity price perspective, it's downside forecast. Now, in terms of inflation, we are expecting it to hit to 4.5% in November 14 first. And then, as you know, as base effect recedes, it's expected to rise back again in the first quarter. But the key number that RBI is looking at is when does inflation transition to 6% sustainably? And we think that period is April 2015, which is well ahead of January 2016 that RBI had put itself as the comfort time frame.
Shubhada, your trajectory?
We are looking at more for the FY16. If oil does settle somewhere, even if at a conservative level at 85, we could see a CPI averaging at 6% in the next fiscal year. If, of course, oil trends even lower than that on an average level at 80, we could see about 5.8, 5.9 average CPI for the next year, which to my mind is a great, huge positive. From a peak of 115, we've seen a 38% cut. Let's not forget RBI had assumed $100 to a barrel, which now stands somewhere close to around 72.5. Of course, we need to see at what level it eventually settles, but broader consensus, I would believe, would emerge somewhere between 75, give or take $2 a barrel. So overall, I think oil is definitely providing the biggest comfort both to the government and, importantly, as the situation evolves, also to the Reserve Bank of India.
Okay. Chetan, Shubhada, morning to both of you. Chetan, can you just tell us what the math looks like now? Given that we've seen a fall of about 35% in crude in the last 6 months, how much will the import bill go down by? Chetan, is my voice reaching you?
Yeah, sorry. The sensitivity to oil prices is about roughly 0.5% of GDP for every $10 change in oil prices. So essentially, that's the impact on the balance of payment. In terms of the implications on oil subsidy, honestly, now we have reached a stage of oil prices where the subsidy has already become zero. So it's not likely to be positive as long as the prices pass through. But now it's almost become irrelevant for oil subsidy perspective. So it's really balance of payment. That's about 0.5% of GDP.
Okay. Well, now to the December 2nd expectation. Shubhada, what's the, your average for the next year is 5.8, 5.9. But, the November number of 4.5 is not also sustainable. What's the governor doing on December 2nd? When are you expecting the first rate cut? And how much over a 12-month period?
I would think that, taking in significant levels of oil at these 72.5, 80, if they settle around that, I think Reserve Bank of India would probably also consider a February rate cut. While until 2 days ago, we were putting it as an outside chance for a February rate cut, but the probability over the last 2 or 3 days seems to have increased. Our base case scenario was of April being the first rate cut of 25 basis points, followed by another 25 basis points somewhere close to the end of second quarter. So overall, we were penciling in about 50 basis point cut in the policy rates over the next 12 months. However, we believe that the oil prices, if they continue to remain at these levels, we probably could see the rate cuts being brought ahead sometime in February. So if we look at growth somewhere settling around 5.4, that's our own estimate for the current year, as inflation trending significantly lower as indicated by the RBI, I would think that evolving situations would be more supportive of an earlier rate cut than before. Of course, RBI is not expected to be trigger happy and instantly announce a rate cut on December 2. I think the situation would be watched as to where eventually the oil seems to settle. But the OPEC meeting of yesterday seems to have formalized the speculative observation that oil is trending at a multi-year low, and this, to my mind, should begin to provide some comfort to the Reserve Bank of India.
So how many cuts you think in the next 12 months?
We're looking at two rate cuts of 25 each, but with some small upside risk as well.
Okay. Chetan, what is the expectation as far as growth is concerned? What's the number that you're expecting later today? And on an average in 2015, what are you penciling in for GDP?
We are at 5.1 to 5.2 for the number that is going to be announced today. And for the financial year, we are maintaining it at 5.7% for 12 months ending March 2015.
Okay. Well, Chetan, just to continue with the credit policy and the interest rate cuts, like I asked Shubhda, what are your expectations? When and how many?
So we are expecting the first rate cut to happen in February. And for this forecast, we had sort of made even before the OPEC meeting, and we have assumed $85–90 of oil price. So we think even if oil prices rises back to those levels, the first rate cut should still probably happen in February. And we are effectively just following the framework that the RBI has laid down. RBI has basically mentioned that as long as they can see 6% inflation visibly, which we think would be possible to see by February, and we are, as I mentioned earlier, seeing that transition to happen from April. So as long as that is visible, it should be possible for them to make the first rate cut in February. And cumulatively, we are forecasting 50 bips as well. But we are also highlighting the bull case scenario, which we have assigned a significant probability of 30%, and said that it's possible that we could transition to 5% sustainably from June 15. In that scenario, if that pans out, which is now possible with oil going lower, and by the time we reach June, we would have known whether oil is sustainably staying lower or not. That would potentially open up the door to do 100 basis points instead of 50 during calendar year 2015.
Okay. Shubhda, one tends to have a facile assumption that when crude prices fall by 35–40%, inflation will fall hugely in India. That would lead to a logical conclusion that you can outsource monetary policy making to the Middle East. If you can just detail for us, exactly how crude prices impact the CPI calculation.
Well, I think for every $10 cut in crude oil prices, we are seeing a 25 basis point direct impact on the CPI. On the WPI, of course, it's a larger impact, 40–50 basis points immediately. So we are looking at a WPI number, for instance, for December, close to 1%, a tad over 1%. So every assumption of a $10 cut in crude oil prices is going to have a direct cut in the CPI forecast by about 20–25 basis points. So we have seen about from 100 to 75, so 25. So we clearly see about 45–50 basis points cut in the CPI forecast. And as I said, we were looking somewhere close to the average of FY16, close to about 6%. And if crude settles below 80, around 80 rather, below 85, we could even see averaging it at 5.8. I think that's well visible within the RBI's fan chart. And more importantly, I would think that if the monetary policy framework indeed is going to formalize it somewhere early in December, we would be probably looking at a scenario where the medium-term target of CPI could get fixed somewhere not at 4, not at 6, but in between, because I think the governor in a couple of occasions had articulated about 4% being inflation definition of industrialized nations. So keeping that in mind, I think 5% is something that we could see that the Monetary Policy Committee could arrive at in terms of a medium-term inflation. We have seen studies by the RBI. We ourselves have done in-house studies on the tolerable level of inflation at a level point which you see a drop in growth. And that somewhere would stand on long-term basis around 6%.
Okay. Quickly, just two numbers. Chetan, where's the 10-year, say, in April and then 1 year down the line?
Lata, I would like to excuse because I don't make the 10-year forecast. So
fair enough.
Fair enough. That one
okay. To you, Shubhada, two numbers from you: the yield projection and your GDP numbers as well.
Well, yield we are looking at settling at about 8% by March. We are looking at about 7.3, 7.5 into the next 12 months. That is 12 months later. As far as GDP is concerned, this second quarter GDP, we are pegging at 5.2, slightly higher than consensus. We are at about 2.5 on agriculture, industry at 2.7, which includes, of course, the construction component, and services at steady at 6.8%. So altogether, agriculture would see some cut. Industry is predominantly being correcting because of flattish manufacturing, though electricity has given a significant support. But services tagged sideways. We are seeing good traction in trade, hotels, transport, communication. We have seen similar move in the finance component also. But government, we could see close to about 9.5%. Base effect will be more favorable for the government services this time round.
Okay, I just have one final question for you, Chetan. We were speaking with the expert at Citi yesterday, and he indicated that he expects Brent crude to slip to as low as $60 a barrel. In fact, he wouldn't be surprised if he sees that level. What is your team at Morgan Stanley forecasting in terms of an average for Brent in the next 6 to 8 months?
Right now we are forecasting about $85 average for 2015. So that is the sort of expectation that we have. But as I mentioned earlier, things have been changing in the way we had expected OPEC to react. The reaction has been a positive surprise for us from macro perspective, but negative for oil. Yeah, so that's the way I would summarize our outlook.
All right. Chetan, Shubhada, thank you very much for joining us with your perspective.